Welcome back to The Explainer. Today, we're diving into an incredibly fascinating breakdown of the financial mechanics behind one of the biggest market events in recent history. We're looking at a really eye-opening recent expose by CrowdWealth titled The SpaceX IPO Illusion, Decoding the Insider Trap. Now, whether you're a casual observer of space exploration or a seasoned market watcher, the structural financial engineering behind this deal is absolutely captivating. Our goal today is to objectively break down exactly what this source material uncovered, peeling back the layers of a truly massive financial ecosystem. So, let's get right to it.
Okay, let's dive into this. $1.75 trillion. On June 12th, the financial world watched as the SpaceX IPO went live, and this was the staggering valuation it commanded right out of the gate. To the public eye, just looking at their smartphone screens, it looked like pure celebration. We're talking green arrows, media euphoria, and a massive wave of retail capital rushing in, absolutely desperate to own a piece of Mars. The scale of this enthusiasm was monumental, and the single trillion-dollar number literally dominated the headlines.
But the CrowdWealth expose asks a completely different critical question beneath all that surface-level hype. If you look past the flashing ticker tape and the public spectacle, who is actually collecting the cash today? The source makes a really compelling point. When a deal is priced this aggressively, it means a perfect, flawless future, one with absolutely zero delayed launches and total dominance for the next decade, has already been bought and paid for by the market. So if the public is paying a massive premium for a future that hasn't even happened yet, who exactly is benefiting from that cash right now?
Section 1. Valuation versus reality. Now let's look at the underlying data. Look, SpaceX is undeniably an operational powerhouse. They routinely launch immense mass into orbit, and their Starlink network serves 10 million users across 150 countries. That's huge, but high finance operates in a completely different reality. While the public listing price was $1.75 trillion, independent Wall Street analysts quietly pegged the company's actual fundamental value much lower, closer to $780 billion. That's more than 50% below the public listing price. Furthermore, the source points out that at this public valuation, SpaceX is commanding $94 of market value for every single dollar of revenue generated last year. To put that into perspective, that is a staggering 94-to-1 ratio for a business that, operationally, is currently losing money.
Section 2. The Lockup Labyrinth. And this brilliantly illustrates the real structure here. The reality of this wealth transfer is completely hidden. On day one of trading, only a microscopic 5% of SpaceX's total shares are actually available for the public to trade. The massive 95% is basically a vault locked away in the dark, held by early venture capital firms, corporate insiders, and executives. Now, normally Wall Street uses a blunt instrument, a standard 180-day lockup preventing these insiders from selling. But the expose details how the architects of this deal built a complex labyrinth instead of a simple cliff.
So this brings us to a highly unusual mechanism buried deep in 150 pages of SEC filings, the performance trigger. Let's unpack this dense legal definition together because it's a real game changer. If the stock ticker SPX trades 30% above its $135 IPO price, which equals $175.50, for 5 out of any 10 consecutive trading days, an additional 10% of insider shares instantly unlock early. Think about the mechanics of what the source is revealing here. The very price pop that retail investors are celebrating online isn't just a victory lap. It acts as a literal tripwire. It's the exact metric designed to trigger an early exit hatch for insider supply.
Section 3. Chronology of insider exits. Let's move to and see how this builds, because the architects left behind a very strict, silent calendar. On day 0, that tiny 5% public float opens up. But look at what happens shortly after. At day 70, the first hidden leak begins, with Tranche 1 unlocking 7% of insider shares. Day 90, Tranche 2 opens up another 7%. Day 105, Tranche 3 hits. Within a very tight window, a steady drip of insider supply quietly hits the open market, long before we ever even reach the traditional 180-day lockup expiration.
When you add it all up, the cumulative effect of these unlocks is just staggering. First, you have staggered tranches 1 through 5 unlocking 35% of the hidden supply. Then come the structural cliffs tied directly to earnings reports. 2 days after Q2 earnings, a massive 20% chunk of insider equity unlocks instantly. After Q3, boom, another 28% hits the tape. By the time we actually reach the traditional 180-day mark on December 9th, a massive 83% of all insider shares will have already become eligible for liquidation. As CrowdWealth highlights, this massive transfer of equity operates completely hidden from the mainstream headlines.
Section 4. The Index Fund Loophole. Now, what's really interesting about this perspective is how the media narratives plays perfectly into this structural reality. Financial media heavily focused on Elon Musk's strict 366-day lockup, framing it to the public as a signal of absolute confidence, right? Like, the captain isn't selling. But the expose argues this is a masterful piece of strategic misdirection. Because Musk controls the vast majority of the voting power, he doesn't actually need immediate liquidity. His highly public lockup keeps the public confident, which completely distracts from the fact that institutional backers, early venture funds, and Tier 2 executives are quietly using those staggered exit doors we just mapped out.
But wait, how is there enough continuous cash in the market to absorb all these insiders selling off their shares? Well, that brings us to this brilliantly complex systemic loophole. Step 1. Under new guidelines, a newly public company can be fast-tracked into the massive NASDAQ 100 index in just 15 trading days. Step 2. Because the public float is tiny, like under 20%, index algorithms actually apply a multiplier, treating that float as if it were 3 times larger than it actually is. Which leads directly to Step 3. Hundreds of passive ETFs and retirement funds are now legally mandated to automatically buy hundreds of millions of dollars of the stock. They become continuous, automated buyers completely independent of the stock's actual valuation, perfectly timing the absorption of the insider shares hitting the market. No way, right? It's literally built into the system.
Section 5. The patient approach. So, the crucial point is, crowd wealth ultimately presents 2 distinct ways to approach this systemic setup. On one side, you have the loud path, buying into the absolute peak of the day 1 hype cycle, sitting in the weakest possible seat and absorbing all that structural liquidation over the next 6 months. On the other side is the quiet path, simply letting the calendar do the heavy lifting and waiting for the unlocked dust to settle by mid-December. By then, the forced buying levels out and the company will have released 2 full quarters of hard public financial data. The market routinely rewards those who patiently wait for reality to price an asset rather than buying into a countdown clock.
Which brings us to our final, really provocative thought from the expose. The number on your screen on IPO day is loud. The financial calendar, however, is quiet. Which foundation will you build your wealth upon? It's a truly fascinating question that challenges us to look beyond the flashing green tickers and understand the deep systemic machinery operating right beneath the surface of the market. I highly encourage you to reflect on these mechanics and use this framework to analyze future market events. Thank you so much for joining